You're collecting setups the way a beginner collects tools they'll never use. Every time you add another pattern to your watch list, another indicator to your chart, another strategy to your rotation, you reset yourself back to square one. You think you're building an arsenal, but what you're actually doing is guaranteeing you'll never develop the one thing that separates professionals from permanent amateurs: unconscious competence in a single high-probability scenario. Right now, you're not a trader, you're a strategy tourist, and the market can smell it in every hesitant entry you take. The professional can feel your uncertainty in how you chase price, how you move your stops, how you exit early when the trade moves against you for 30 seconds. Every decision you make broadcasts that you're operating from a place of confusion rather than conviction. And confusion in trading is just expensive education that most people never graduate from. There's a belief that's killing your progress, and it sounds completely rational when you first hear it. The belief is this: the more setups you know, the more opportunities you can capitalize on, which means more trades, which means more profit. It feels like basic math. If trader A only knows one pattern and trader B knows 5 patterns, then trader B should theoretically have 5 times the opportunity. This logic is so seductive that thousands of traders build their entire approach around it, and it's precisely why most of those traders never make consistent money. Here's what actually happens. When you know 5 setups at a shallow level, you don't get 5 times the opportunity. You get 5 times the confusion. You get 5 different voices in your head when you look at a chart. You get conflicting signals that create internal debate, and that debate creates hesitation. And that hesitation either makes you miss the entry entirely or take it late with reduced conviction, which changes your position sizing, which changes your risk management, which means even when the setup works, you make less than you should have. And when it doesn't work, you lose more because you held longer trying to prove to yourself that you made the right choice. The hidden consequence isn't just that you trade worse, it's that you never build the pattern recognition database that allows for instant execution. Your brain never gets the repetitions required to move from conscious analysis to unconscious recognition, which means you're perpetually operating in the slow, deliberative, error-prone mode of thinking. You never graduate from beginner to professional because you never stop thinking like a beginner. And here's the part that destroys most traders. You can spend 5 years trading and still be a beginner if those 5 years were spent scattered across multiple approaches rather than going deep into one. Time in the market means nothing if that time wasn't focused. You could have 10,000 hours of screen time and still execute like someone in their first month if those hours were divided among 10 different strategies. The learning doesn't compound, it fragments. Paul Tudor Jones started with $40,000. He turned it into billions. Not with a dozen strategies, not with a multi-time frame, multi-indicator, multi-pattern approach. He had one setup he waited for with the patience of someone who understood that forcing trades outside his edge was the fastest way to go broke. He looked for momentum breakouts in specific market conditions, and when those conditions weren't present, he did nothing. He's on record saying he would sit for weeks without taking a position if his setup wasn't there. Think about that. One of the most successful traders in history, sitting in cash, doing nothing while everyone around him was busy. He wasn't lazy, he wasn't scared. He was disciplined enough to understand that his edge only existed under specific circumstances, and trading outside those circumstances wasn't trading at all, it was gambling. What's more important than what he traded is what he refused to trade. He didn't take reversal patterns, he didn't take range-bound setups, he didn't trade chop. He watched, he waited, and when his exact scenario appeared, he attacked it with size, because he'd seen it so many times that execution was automatic. No deliberation, no second guessing, just recognition and response. Jones has described his approach as waiting for what he called the setup with the most asymmetric risk-reward. And the only way you know you're looking at asymmetric risk-reward is if you've seen that exact setup enough times to know what happens next with high probability. The multi-setup trader never develops this predictive sense because they're always looking at something slightly different, always recalibrating, always uncertain. Jones could look at a chart for 5 seconds and know whether his edge was present. That's not talent. That's 10,000 repetitions of the same pattern creating pattern recognition so deep it operates below conscious thought. A chess grandmaster looks at a board position for 3 seconds and knows the next 5 moves. Not because they're smarter than you, not because they have better memory or higher processing power. It's because they've seen that pattern, or patterns similar enough to it, thousands of times. Their brain doesn't analyze the position consciously, it recognizes it unconsciously. The amateur chess player looks at the same board and starts calculating. They think through possibilities, they evaluate options, they deliberate. And while they're doing that, the grandmaster has already moved, because for them, there's nothing to think about. The pattern triggers a response that's been encoded through repetition. This is not memorization. Memorization is conscious recall of stored information. Recognition is unconscious pattern matching that bypasses the slow analytical process entirely. In martial arts, this is why a black belt doesn't think about which technique to use when someone throws a punch. Their body responds before their conscious mind registers the threat. The punch comes at their face, and their hand is already moving to block, not because they decided to block, but because their nervous system recognized the pattern threat and activated the motor response automatically. In music, this is why a virtuoso doesn't think about which finger goes on which string. They see the notation and their hands move. You can watch their eyes and you'll see they're reading measures ahead of what their fingers are playing, because the execution is automated. The conscious mind is freed up to handle expression and dynamics, while the technical execution runs on autopilot. The transfer to trading is direct and exact. When you've taken the same setup 500 times, you don't analyze it when it appears. You recognize it. Your hand moves to the mouse, you size the position, you set the stop, you enter. And all of this happens in the time it takes the multi-setup trader to ask themselves which pattern they're looking at. But here's where it gets really interesting. Neuroscience research on expert performance shows that this unconscious recognition isn't just faster than conscious analysis, it's also more accurate. The conscious mind can hold about 7 pieces of information at once. The unconscious pattern matching system can process millions of data points simultaneously. When a chess grandmaster looks at a board, they're not consciously analyzing each piece. Their brain is matching the entire configuration against a massive database of positions they've seen before. This is why grandmasters can play 30 games of speed chess simultaneously and win almost all of them. They're not thinking faster, they're not thinking at all. They're recognizing and responding. This is the state you need to reach in trading, and you will never reach it if you're constantly asking your brain to recognize different things. This is what we call the grandmaster feel. It's the point at which trading stops being an intellectual exercise and starts being a reflex. You're not thinking, should I take this trade? You're not weighing probabilities. You're not consulting your checklist. You see it, you recognize it, and you execute. The recognition happens in the limbic system, the ancient part of your brain responsible for pattern matching and threat detection, and it's faster than the prefrontal cortex by orders of magnitude. This is why execution speed is the real edge. It's not that you see the setup before others, it's that you act while others are still thinking. You're in before they've finished their analysis. You're managing the trade while they're still confirming their entry. And because you've taken this specific trade hundreds of times, you don't have emotional volatility around it. It's not scary. It's not exciting. It's just data. Another repetition, another iteration of a pattern you know intimately. The multi-setup trader never reaches this state because they're constantly switching contexts, constantly relearning, constantly starting over. Their brain never builds the deep neural pathway required for unconscious execution because it's always being asked to recognize something different. They stay in the slow, conscious, analytical mode forever. And in trading, slow is the same as wrong. Think about what happens in your body when you take a trade. If you're uncertain, your heart rate increases, your breathing changes, your pupils dilate, stress hormones flood your system. This is your body preparing for threat response because your nervous system can't tell the difference between trading uncertainty and physical danger. Now compare that to the trader who has taken their setup 500 times. Their heart rate stays normal, their breathing is steady. Their body knows this isn't a threat, it's a routine action with a known probability distribution. This physiological difference affects everything. The stressed trader's vision literally narrows. They experience tunnel vision, which means they miss peripheral information that might be relevant. Their reaction time slows. Their decision-making becomes more emotional and less rational. The calm trader sees the whole picture. They process information faster. They make better decisions. And this isn't about meditation or breathing exercises or any of that. This is about familiarity. Your nervous system calms down when you're doing something you've done hundreds of times before. It stays activated when you're doing something novel or uncertain. The multi-setup trader is always in a state of low-grade stress because they're always dealing with some level of novelty. Let's compare two traders in detail. Trader A knows one setup and has taken it 300 times over the past 18 months. Same number of total trades, same amount of screen time. But trader B has no depth in any single pattern. They're still figuring out the nuances. They're still surprised by variations. They still hesitate before entry because they're not certain. They size smaller because they lack conviction. They exit early because they don't trust the process. They don't know that setup number 3 works better in the morning because they haven't taken it enough times in different parts of the day to see the pattern. They don't know that setup number 5 fails more often when volatility is low because they haven't tracked that variable across enough iterations. When trader A sees their setup, they enter in 2 seconds. They see price, they see structure, they see their trigger, they click. When trader B sees any of their 5 setups, they take 15 seconds to confirm it's actually that setup and not something similar. Another 10 seconds to check if conditions are right. Another 5 seconds to talk themselves into it, and by then, the entry is either gone or degraded. And here's the critical part. Intelligence has nothing to do with this. Trader B could have a higher IQ, could have read more books, could have better analytical skills, could understand market theory at a deeper level. None of that matters. Because trading isn't an intelligence test, it's a pattern recognition test, and pattern recognition is built through repetition, not through intellectual understanding. Trader A is better not because they're smarter, because they've seen their specific thing so many times that their brain automated the response. Trader B is still manually processing every decision, and manual processing is slow, error-prone, and exhausting. By the end of the trading day, Trader B is mentally drained from making dozens of conscious decisions. Trader A is fresh because most of their execution was automatic. This difference compounds over months and years. Trader B eventually burns out or quits or stays stuck. Trader A keeps improving because they're building on a foundation that gets stronger with each repetition. Walk through what happens inside your head when you're watching a chart and you think you might have a trade. If you know multiple setups, your first question is, which setup is this? You're looking at price action and your brain is flipping through your catalog. Is this a bull flag? Is this a breakout retest? Is this a liquidity sweep? Is this a failed auction? Is this an order block? Is this a breaker? You're asking identification questions before you even get to execution questions. And that identification process takes time and creates uncertainty. Now let's say you tentatively identify it as setup number 3. Your next question is, do current conditions favor setup number 3? You check the higher time frame, you check volume, you check volatility, you check market internals, you check time of day, you check whether price is near major support or resistance. Each check introduces another variable, another opportunity for doubt. Let's say you decide conditions are acceptable. Now you have to remember the rules for setup number 3 specifically. Where's the entry? Where's the stop? What's the target? What's the management plan? You're pulling this from memory, and memory under pressure is unreliable. Meanwhile, price is moving. The setup is evolving. Maybe it's already moved past your ideal entry. Maybe it's starting to look less clean than it did 10 seconds ago. And while you're going through this mental checklist, trying to remember the rules and verify the conditions and overcome your hesitation, the opportunity is degrading. By the time you finally take the trade, you're late, your conviction is low, your sizing is conservative, and you're already preparing yourself to be wrong. This isn't a skill problem. This is a mental noise problem. You have too much information competing for attention, and that competition creates paralysis. Compare this to the single setup trader. They look at the chart, they either see their thing or they don't. If they see it, they enter. No identification process, no catalog to search, no debate. Just pattern recognition and reflex response. Their only question is, do I have my edge right now? And because they've trained their eye on one specific pattern, the answer is almost always immediately obvious. They're not searching, they're not comparing, they're not deliberating. They're looking at price action the way you look at a traffic light. You don't think about whether the light is red or green, you just see it and respond. That's the level of automaticity you need in trading, and you will never develop it if you're constantly switching between different systems. Every time you switch setups, you reset your emotional calibration. Your brain treats each pattern as a new context, which means your fear and greed responses aren't habituated. You're emotionally volatile around the trade because you don't have enough repetitions to trust it. This shows up in predictable ways. You enter a trade with setup A. It goes against you slightly. You exit early because you don't have the experiential data to know whether this is normal noise or actual failure. You just took a small loss. Now you're in a mild emotional deficit. Your brain is slightly activated. Cortisol levels are elevated. Your amygdala, the fear center of your brain, is more sensitive to potential threats. You see setup B form. You take it, but because you're still processing the previous loss, you size smaller than you should. This one works, but you make less than the setup warranted. Now you're frustrated because you traded well but didn't capitalize fully. This frustration is another form of emotional activation. You see setup C. You take it, but this time you're trying to make back what you lost and what you didn't gain, so you size larger. It fails. Now you're in a real emotional hole. Multiple losses combined with a missed opportunity have pushed you into a high-stress state. Your prefrontal cortex, the part of your brain responsible for rational decision-making, is partially offline. You're operating more from your limbic system, which is emotional and reactive. You see setup D. You're hesitant because you've taken 3 emotional hits in a row. You either skip it and it works, which creates regret and self-doubt, or you take it but late and small, which means even if it works, you barely recover. None of these are technical errors. These are emotional execution errors caused by context switching. The single setup trader has none of this. They take their setup, it works or it doesn't. They have hundreds of data points telling them what normal looks like. They know that their setup wins 65% of the time and that losses are part of the statistical distribution. When it loses, they don't experience surprise or emotional disruption. It's just the 35% showing up. They don't exit early because noise doesn't scare them. They've seen this exact price action 100 times before. They don't size incorrectly because their confidence is calibrated to their actual edge. They know their real win rate. They know their real average winner versus average loser. This isn't hope or belief. This is data encoded through experience. They don't revenge trade because they're emotionally flat. When you have one setup, your emotional system habituates to it. You develop the trader's equivalent of a surgeon's steady hand. The surgeon can cut into human tissue without emotional response because they've done it thousands of times. It's not that they're cold or unfeeling, it's that familiarity removes emotional charge. The multi-setup trader never habituates because they're always in a different emotional context, always recalibrating, always slightly off balance. They experience each trade as somewhat novel, which keeps their nervous system activated, which guarantees emotional trading, which guarantees inconsistent results. Every trading edge is conditional. It exists under specific market regimes and disappears outside those regimes. A trending market edge doesn't work in a ranging market. A breakout edge doesn't work when volatility is compressed. A mean reversion edge doesn't work when momentum is strong. A volatility expansion edge doesn't work when implied volatility is already elevated. An opening range breakout edge doesn't work when overnight gaps are large. The professional trader understands this intimately because they've taken their setup in enough different conditions to map when it works and when it doesn't. They know their edge requires volatility above a certain threshold. They know it requires a specific market structure. They know it performs better in certain sessions. They know it works better on certain days of the week. They know it fails more often near major economic releases. This knowledge doesn't come from backtesting. Backtesting can give you hints, but real understanding comes from live repetitions where you're actually risking capital and experiencing the emotional reality of wins and losses. The multi-setup trader never develops this conditional awareness because they don't have enough reps in any single setup to see the patterns. They take setup A in 5 different regimes and don't realize that 4 of those regimes had no edge at all. They think they have a 50% win rate on setup A, but actually they have a 70% win rate in the right regime and a 30% win rate outside it, and they can't tell the difference because they haven't taken it enough times. So they trade it in all conditions, which means they're trading outside their edge most of the time. They're literally choosing to take trades with no statistical advantage, not because they're stupid, but because they haven't done the repetitions required to see when the edge is present and when it's absent. The single setup trader knows exactly when to trade and when to sit. They can feel when market conditions align with their edge, not because they're mystical or intuitive, but because they have a massive sample set of data encoded in their experience. They've seen their setup work 100 times when X condition was present and fail 100 times when it was absent. That pattern is burned into their neural circuitry. They don't have to think about it, they just know. They look at a chart and within seconds they know whether their edge is available. If it's not, they close the chart and walk away. No FOMO, no forcing, no taking marginal trades because they're bored. This is the difference between a professional and someone who's going to stay stuck forever. The professional has the experiential data to know when not to trade, and knowing when not to trade is more valuable than knowing when to trade because it keeps you from giving back your gains during periods when you have no edge. The best traders in the world spend most of their time doing nothing. Stanley Druckenmiller has talked about sitting in cash for months waiting for what he called a high-conviction opportunity. Not because he couldn't find trades, he could have traded every day if he wanted to, but he understood that trading without edge is just expensive entertainment. George Soros reportedly took one major position per year during his peak, betting large when conditions were perfect and doing almost nothing the rest of the time. These aren't examples of laziness or fear. These are examples of understanding that waiting is not the absence of work. Waiting is the work. Discipline isn't what you do, it's what you don't do. The amateur trader sees inactivity as lost opportunity. The professional sees inactivity as capital preservation and preparation. They're not waiting passively. They're watching, studying, staying sharp, keeping their edge fresh, so that when their setup appears, they're ready to execute with full conviction and appropriate size. Ed Seykota, one of the most successful traders ever documented, would go weeks without taking a trade. He described his approach as waiting for the market to give him money, not trying to take money from the market. That subtle reframe changes everything. When you're trying to take money, you force trades. When you're waiting for the market to give you money, you only take the gifts. And the market only gives gifts under specific conditions, which means you need to know what those conditions look like, which means you need massive repetition of a single setup so you can instantly recognize when conditions align. The trader who takes 10 trades a week thinks they're working harder than the trader who takes 1 trade a month, but effort and results have no correlation in trading. The only thing that matters is whether you're trading with an edge or without one. 10 trades with no edge is worse than 1 trade with a significant edge, and the single setup specialist knows this because they've experienced it directly. They've lived through the periods of waiting and seen that their account grows faster when they trade less but better. They've tracked their results and seen that their best months weren't the months where they took the most trades. Their best months were the months where they took the fewest trades, but each one was high conviction and well executed. This is the opposite of what most traders believe, and it's why most traders stay poor. The modern trading landscape is full of concepts, frameworks, systems, methodologies, smart money concepts, institutional order flow, market maker manipulation, liquidity hunts, inducement, fair value gaps, order blocks, breaker blocks, mitigation zones, premium and discount zones, equilibrium, optimal trade entry, turtle soup, VWAP, market profile, volume spread analysis, Wyckoff accumulation and distribution. The list is endless and expanding. Most traders consume this material the way tourists consume landmarks. They take a picture, move on, never return. They understand the concept intellectually, but never master it practically. They can explain an order block, but they've never taken 50 order block trades and tracked the results. They can describe a liquidity sweep, but they've never built a database of what actual sweeps look like across different instruments and timeframes. They can talk about fair value gaps, but they've never tested whether fair value gaps actually provide edge in the specific market and timeframe they trade. They're collectors, not practitioners. They're building a library of knowledge that looks impressive but produces no income. The trader who masters one concept, whether it's as simple as a moving average cross or as complex as institutional order flow, will always outperform the trader who understands 10 concepts superficially, always, because mastery comes from depth, not breadth. The insights that matter, the edges that persist, the execution skills that produce consistent profits, all of these emerge only after you've gone deep enough into a single approach that you start seeing things other people miss. You notice the subtle differences between the version of your setup that works 80% of the time and the version that works 40% of the time. You notice what happens the bar before your setup triggers. You notice how it behaves differently on different days of the week. You notice that it works better when it forms near round numbers. You notice that it fails more often when it forms after big news releases. These are not things you can learn from a video or a book. These are things you discover through repetition and attention. The concept collector never gets there because they're always moving to the next thing before they've exhausted the current thing. They see diminishing returns on their learning curve and assume they've learned all there is to learn, but actually they're still in the shallow phase. Real mastery begins where most people quit. The first 100 repetitions teach you the basics, the next 100 teach you the nuances, the 100 after that teach you the exceptions, and somewhere past 500 repetitions, you start seeing patterns that nobody talks about because they're too subtle to notice without massive data exposure. That's where edge lives, in the details that only reveal themselves through obsessive focus. And you will never reach that level if you're constantly distracted by new concepts and new systems. Everything you've been told about opportunity is backwards. You don't need more setups to make more money. You need more precision in one setup to make more money. The trader with 5 setups makes 5 mediocre trades. The trader with 1 setup makes 1 excellent trade. Excellent beats mediocre every single time, and it's not even close. When you focus, your pattern recognition sharpens. Your execution tightens, your emotional control stabilizes, your confidence compounds, your learning accelerates because you're iterating on the same thing instead of starting over. Every repetition makes you slightly better, and those increments stack. After 200 reps, you're not quite as good as you were after 100 reps. You're exponentially better because each layer of understanding builds on the previous layer. The multi-setup trader never experiences this compounding effect because they're always in the early phase of the learning curve, always figuring out basics, always starting from a shallow foundation. They work just as hard, spend just as much time, but they're running on a treadmill while the specialist is climbing a mountain. Same effort, completely different trajectory. You can see this clearly if you track performance over time. The multi-setup trader's equity curve stays flat or choppy. They have good periods and bad periods, but no clear trend upward. They make money one month, lose it back the next. They have quarters where they think they figured it out, followed by quarters where they're back to break even. There's no momentum because there's no compounding of skill. The single setup trader's equity curve trends up with lower volatility because they're not guessing, they're not hoping, they're not trying new things. They're executing the same refined process over and over, and the market rewards consistency. Their equity curve looks boring, and boring is exactly what you want. Smooth, steady, predictable growth. No dramatic peaks and valleys, no months where you make everything back. Just consistent, positive expectancy expressing itself over time. This is what professionalism looks like in trading, and it's only possible when you've gone deep enough into one thing that execution becomes automatic and edge becomes clear. You're standing at a decision point right now, whether you realize it or not. Option A is to keep doing what you've been doing, keep collecting strategies, keep watching new videos, keep adding new patterns. Stay busy, stay scattered, stay average. Continue producing inconsistent results. Continue feeling like you're working hard but not getting anywhere. Continue wondering why some people make it and you don't when you're putting in the same hours and have access to the same information. Continue telling yourself that you just need to find the right system, the right indicator, the right setup. Continue searching for something external when the problem is internal. Continue believing that more is better when the evidence of your own account clearly shows that more is just more confusion. Option B is to make a single choice and commit to it completely. Pick one setup, not the best setup, because there is no best setup, just one setup that makes logical sense to you and appears frequently enough to give you repetitions. Trade only that for 6 months, for a year, for as long as it takes to reach unconscious competence. Take it in every market condition so you learn when it works and when it doesn't. Track every iteration, study every failure, refine your entry, your stop placement, your management, your exit. Build a database in your mind of what this setup looks like in all its variations. Let your brain automate the response. Stop thinking and start recognizing. Become a specialist. Become dangerous, not because you know more, but because you know one thing better than anyone else needs to know anything. Stop trying to be good at everything and become exceptional at one thing. The choice is binary. There's no middle ground. There's no compromise position where you sort of focus but also sort of diversify. You either commit to depth or you stay stuck in shallow water forever. You either build real skill through concentrated repetition or you keep pretending that knowledge accumulation is the same as skill development. It's not. You can know 100 setups and execute none of them well, or you can know one setup and execute it with the precision of a surgeon. One of these paths leads to consistent profitability. The other leads to years of frustration and eventual failure. The market doesn't care about your knowledge, it only cares about your execution. And execution quality is a direct function of repetition volume in a single context. Everything else is noise.